So now that we have an understanding of what constitutes good audit evidence, we can turn our attention to the different procedures we use to actually collect that evidence. So we've talked a lot already in chapters 3 and 4 about the risk assessment stage of the audit, and we had a number of examples of different procedures used to collect audit evidence. For example, we talked about discussions, inquiries we'd have with management, maybe concerning the operations of the company. We looked at analytical procedures, which are actually required during the risk assessment stage. So recall, analytical procedures include things like ratio analysis or trend analysis, which maybe gives us a better feel for the company's operations and can help us plan the audit by pointing us to areas where we might have to focus a little bit more attention because of certain risks that we find through these analytical procedures. And then the test of controls is what we're going to start talking about over the next couple chapters. And these are basically different methods to figure out if a client's internal controls are operating effectively. A third category that we're going to spend a lot of time focusing on in the second half of the course is substantive procedures. These are basically including the detailed investigation into accounts. So maybe we have an account balance for inventory of $100,000 on the balance sheet. A substantive procedure would go back and try to verify that they actually have $100,000 worth of inventory. Now, you're not going to necessarily look at every piece of inventory. You're going to pick and choose certain pieces of inventory to kind of highlight. So remember, we're giving reasonable assurance on the financial statements, not absolute assurance. So when the auditor plans out the audit, if we think there's a lower risk of material misstatement to begin with, we won't have to test these accounts in as much depth as if we thought that there was a higher likelihood things were misstated. So those substantive procedures are really kind of getting into the nitty-gritty, dirty work of doing the audit, actually going into the accounts and trying to figure out if the numbers are saying what they should be actually saying. Now, there's a number of different types of audit procedures. They could fall under these three different categories. We can see here inspection of assets. We've talked about this a little bit already in the past. Remember, we had an example where the auditor was going out to verify that some equipment the company claims they owned actually exists. So imagine that the auditor was working with a client that was in agriculture and they listed a bunch of equipment on their balance sheet. So maybe we drive out to their farm, we walk around the farm and verify that the equipment that they say they actually have does in fact exist. Now, we could also use technology to do the same form of inspection of assets. So in the past few years, drones have become increasingly more popular with auditors. You might not think of drones and auditing kind of going together, but auditors will use drones in a situation like that where they'll fly the drones over the field, use the camera on the drones to verify that these assets actually exist. So we're going to go in detail and look at each of these different types of audit procedures. This particular slide gives you some good examples of how technology is actually used to help auditors perform these procedures. So we'd like to be able to collect the evidence in the most efficient manner possible. So, technology a lot of times helps us accomplish that. Now, inspection can be used during different points in the audit. So we could use this in the risk assessment stage of the audit to try to get a feel for the risks inherent to the company and to help us plan our audit. We could also use this when we're testing controls or as substantive procedures. So one very important way of using inspection is looking at documents and assets. So particularly with documents, there's two main ways that we go about doing inspections, and this is really critical. We're going to talk about these two forms of inspections in a lot more detail later on down the line. The first one is vouching, where basically you're looking at numbers either in the GL or in journal entries, and you're vouching those back to source documents. So we use this to provide evidence for the occurrence or existence assertion. Tracing is kind of the opposite way. We look at the source documents first, and then we kind of trace that to what's in the journal and ledger, and that provides evidence for completeness. So let's think about the one example we talked about in the past with accounts payable and kind of see how that plays out with these definitions of vouching and tracing. So remember, I gave you an example of a company that had $20 million in accounts payable on their balance sheet. And we could see how we could use each of these different techniques to test different assertions involving that accounts payable figure. So imagine first off this idea of vouching. Remember, vouching is looking at numbers in the ledger or journal and tracing those back to the source document. So we have a $20 million balance for accounts payable on our balance sheet. What the auditor is going to do is pick out certain transactions that made up that balance. Maybe one of the accounts payable transactions that were made during the year was like for $100,000 to a certain vendor. Let's say they bought goods off company XYZ. They owe them $100,000. So there's a transaction, a journal entry in the system. All right, that $100,000 is a part of that $20 million balance for the payable account. So we're going to go back and verify that. Basically, we're going to look at that journal entry. We see, okay, we're saying we owe $100,000 to XYZ. Let's go see if we have source documents that actually verify that. So the auditors will go out and maybe go to the folks in the accounts payable department and ask them, hey, do you have the invoice for this $100,000? We allegedly bought goods from this company. It's listed here as a payable, all right? Did that actually occur? Does that payable exist? All right, so using the vouching technique is helping us figure out whether the existence or occurrence assertions are actually proper. Notice that didn't help us with completeness, right? Even if we looked at every individual transaction that constituted that $20 million balance, that doesn't tell us we have completeness. There could be other transactions out there that weren't recorded. We're only actually looking at the ones that were recorded when we do this vouching technique. So kind of the alternative technique or the opposite technique is tracing, and this does help us test for completeness. This starts with the source document, and then so basically we can go into the accounts payable department, ask for all the invoices they got from vendors over the course of the year. Then we can start checking those to make sure they were actually entered into the system, journal entries were made, and they appear in the general ledger. Now that's a test for completeness, because if we have some invoices from our vendors that we never actually entered into the system, that means we're missing some transactions. We're missing, the balance of our accounts payable is going to be understated, basically. So that's a test for completeness. So just keep in mind, vouching is kind of going from the ledger backwards. Tracing starts with the source documents and then goes and looks at what we actually entered into our accounting system. Now, another technique we use is observation. A lot of times I see folks kind of get tripped up between the definitions of inspection and observation. Inspection means you're going to go and look at something at one point. So we inspected the assets for the farm. We made sure they were there, whether we did that by physically walking around the farm or using the drone. Observation is kind of similar. You're on hand, you're looking at something, but you're looking at a process or a procedure being carried out by personnel. All right, so imagine we're going in and observing an inventory count. We're watching people actually take inventory. That's different than an inspection. If we go and inspect inventory, we walk to the warehouse and look and make sure the inventory is there. That's inspection. Observation would be actually watching people carry out the count of the inventory. Now, a big area of concern for auditors is external confirmation. So especially when we're talking about the accounts receivable account, this is particularly important. So remember, we talked about that idea that evidence that management presents to us might be somewhat questionable in some cases. Maybe they have incentives to kind of distort the truth or paint things in a better light. So if we have outside information, outside evidence, that's usually more useful to us. So for instance, with the accounts receivable balances, we might want to go out and actually send inquiries to the individuals that the company sold the goods to make sure that they actually do owe that company money. So maybe on our client's books, they have, a $200,000 account receivable for ABC Company. So we can go out and contact ABC Company and ask them, hey, do you actually owe the company $200,000? Right? That's what we call an external confirmation. So that's considered to be more reliable than just using internal information provided by the firm. Now, there's a couple of different ways we can go about conducting these confirmations. In addition to receivables, bank confirmations are a big form of external confirmation, oftentimes used by auditors. Basically, a bank confirmation is just a request for information about the company's dealings with the bank. So they might tell us, the account balances on hand. They might give us details about any loans outstanding. All right, so that's very useful information. That's a great, very high level source of audit evidence because it's provided by a third party who has probably less incentives to mislead us than the client themselves. And we talked a little bit already about receivable confirmations, and there's two different ways to actually confirm information: positive and negative confirmations. So positive confirmations typically ask the recipient to reply in all circumstances. So in regards to receivables, again, maybe we send out an inquiry to one of the company's customers to make sure they actually owe the company the money. The company's stating that they do own the receivables balance, and we ask them, please reply in all circumstances. A negative confirmation means that we ask the recipient to only reply if they disagree with the information provided. So maybe we send out a confirmation to a customer and we say, okay, well, we see here that you owe $20,000. If that's the case, you don't have to reply. But if that's wrong, if you don't in fact owe $20,000, please let us, the auditor, know. All right, that's an example of a negative confirmation. Negative confirmations are used sometimes with receivables, but only in very specific situations. So typically, auditors use positive confirmations. Negative confirmations don't provide us as high of a level of audit evidence because if we don't get a response back with a negative confirmation, we really don't know if that means that the recipient's seen it and they actually kind of agree with it and that's why they didn't respond, or maybe they never got the inquiry, maybe they never got a chance to respond, it got lost in the mail, or whatever the case is. So positive confirmations are much more useful, and in practice, typically they are used. You could have situations where maybe receivable balance is very minimal for a customer, so it's not that important. In a case like that, maybe you'd use a negative confirmation, but typically we have positive confirmations being used in practice by auditors. Another technique to collect audit evidence is recalculation. So basically, this is just looking at the calculations that were made by the accountants at the firm and just kind of double checking their work. So this could be as simple as just kind of re-adding numbers in a spreadsheet to make sure that they were added correctly, or these could be more complex recalculations, the calculation for payroll tax or calculations dealing with foreign currency translations. Basically, if we do a recalculation, we're kind of double checking the work of the original accountants and their entries that they made. Now, kind of an associated form of getting audit evidence is reperformance. So this is basically, it's oftentimes used with tests of control. So basically we're reperforming whatever type of work was done. So for instance, let's say we have an internal control over cash disbursements where somebody, an executive or management or manager in the company is basically going to sign off on any cash disbursements. All right, so if you're in the department actually making the disbursements, you're not supposed to actually write any checks until management signs off on it. So we can go back and kind of reperform this process. We could look at all the checks that were written, and we can make sure that we actually had the verification on hand, all right, to actually allow those checks to be written. So we make sure we have all the signatures in place. So basically, as the auditor, we're reperforming this internal control process to make sure it was done correctly to begin with. And we talked a little bit earlier about analytical procedures. Remember, these analytical procedures are absolutely required during the risk assessment stage. So when we're in this first stage of the audit, gathering evidence about the different types of risks that face the company and trying to figure out our audit plan, right, we're required to actually undertake analytical procedures such as ratio analysis or trend analysis. Now, analytical procedures can also be used as a substantive procedure during the risk response phase. So remember, during this phase, we're trying to collect information about the detail of accounts. All right, so we could use analytical procedures to kind of give us some additional audit evidence to verify whether the accounts have any material misstatements. The last technique I want to talk about is scanning. And basically, scanning is just kind of looking over different entries to see if there's any unusual individual items. So maybe you're looking at the GL account for receivables, and you know most of the receivables are between like $500 and $1,000 for a company, and you see one that's like $30,000. That might jump out to your attention, so that's something worth investigating. So this is basically just looking out for unusual items. This can be kind of done just by eyeballing the different accounts, looking at them, or we could use different type of software that actually tries to catch any issues like this for us. So again, auditors like to use different forms of technology to make their jobs easier, but there's always the cost benefit issue. We might be able to use some special software that does the scanning for us much more quickly than we could do on our own, basically by just looking at the numbers with our eyes. But there's a cost associated with that. So if the cost of that special software is going to exceed the cost of paying the auditors extra time to kind of visually look over this stuff, we probably don't want to use the software. So we got to take those pluses and minuses into consideration when we're determining what type of technology to apply at the different stages of the audit.